Hey everybody, Mavericks are back. It's Thursday, 3 p.m. Welcome back, Mike and Scott. How you guys doing?
Good. Hello.
Good. Very good. So let's just jump right into it. So Scott, just before we started, we were talking about the options expiration. You were saying it's the biggest one ever. Is that what you were saying?
Yeah, for Bitcoin and Ethereum, this is the largest quarterly options expiration in history, which is tomorrow. So, it's the last Friday of every month. You get the monthly expiration, but this also is the quarterly expiration, and it's about $15.2 billion tomorrow. 9.5 of that is Bitcoin, 5.7 of that is Ethereum. So, in previous cycles, it used to be sort of the max pain joke that everyone's heard. The way this happens usually is if you're close to the price of max pain, which is the price where the most options would expire out of the money, you tend to see price pushed in that direction at the expiration because someone stands to make a whole ton of money by pushing price to that level. Well, on this quarterly expiration, because of just how high the market has gone, the point of max pain is like $50,000 Bitcoin. It's so far from price that it's almost irrelevant. So this time, a lot of analysts are predicting for once that we'll see volatility to the upside on the options expiration because that floor will be cleared and there's really no reason for anyone to attempt to push the price down. In fact, right now, about 40% of the options are in the money, which is exceptionally high for 40% to be winning on a quarterly expiration. And so more would be in the money if that was actually pushed up. So right now you have more incentive for somebody to push price up, in theory, to have more options in the money rather than pushing to where they're out of the money. But this expiration is going to wipe 40% of the notional open interest on Bitcoin from the market across all contracts and expiration. So this is absolutely, relative to the size of the market and just in general, it's an absolutely huge expiration tomorrow. That's going to happen at 8 a.m. UTC. This is all on Deribit, who has like 90% of the market. But by the time we wake up, it'll probably be over if we're seeing anything. But it's interesting that for once we might see price pushed up on the options expiration.
So just to clarify, is it usually that price goes down before the options because they want to get it down to where most? So we're not seeing that obviously today. Price is grinding higher. We're above 70,000.
It would have to get to fit right. It would have to get to 50,000. So usually it would be like price is 40, max pain is 39.3, right, or something like that. And so
it's way
you see it
far
getting
out of
pushed.
there.
But we've flown so far above the people who were making those bets 3 months ago. Nobody expected all-time highs before the halving, right? So people were comfortable making those bets, and here we are.
So do you think that once we clear this, do you think the runway is now open to, let's say, go up to 80 before the halving, or what are you thinking in that regard?
Yeah, I'm not sure where it's going to go. I mean, we were already at 74, right? So 80 is a rounding error if you're looking at percentages when we see 5 to 10% Bitcoin moves on a daily basis. I just think that there's way more upside and tailwinds than headwinds right now, both in the market and fundamentally.
Interesting. Mike, what do you got for us in terms of Bitcoin? Do you have any bearish analysis for Bitcoin? Or is it all clear sailing?
That's probably why it's going to go down. No. Yeah. But I do appreciate you bringing back memories. The key thing about being an ex-reformed over-the-counter options trader, U.S. Treasuries in the 90s in New York City, is pin risk. And I remember sometimes I'd get lifted out of stuff. I'd be short calls or something on a day like today. I'd be at the strike. And it ruined my whole weekend because you're in the money and then you're out of the money, in the money and then out of the money because you're right at the strike. It's a pin risk. I assume the biggest strike is probably 70 grand. I don't even look at it. I deliberately ignore that stuff. But I really appreciate your comments. And the key lesson I learned is when you move in an options market and you close in at expiration above a significant strike that has a concentration open interest, usually it's quite the bullish sign for the next move. So we'll see how that works. But that's just my memories of how those things work. And I deliberately do not do that anymore. And I used to have hair.
Yeah, really quickly for market makers and institutions right now, I'm just reading about this as Mike was saying it. He's correct. So on the hedging side, looks like the major strike here is 70,000. There's about 50 million of gamma, with the majority focused around the 70K strike. So if you're wondering if Mike knows what he's doing and he can call that blind, well, there you go.
It's one of those. It's the DI list, the deliberately ignore. But I got a few charts I want to show you. We'll start with Bitcoin, just first of all, today, right now, record monthly and quarterly closes for Bitcoin, gold, and the S&P 500. The key question is where they're going to close at the end of Q4. And all we all know is if markets keep going up, Bitcoin will win. Typically, if history is a guide. volatility is a guide, the fastest horse in the race. The key question is at some point we have to get that back up in the S&P 500. It just give me a 10% correction. That's what I want to see. So as a trader, I would look to readjust and to pick up on stuff. There's one thing that I'm sure most people haven't seen yet is I want to show you this chart of MicroStrategy. If you take MicroStrategy in white,
can I just jump in, Mike? You just said something, and I'm curious as to your point because you've been around for a long time on Wall Street. So you said, we're just looking for a 10% correction. Give us a correction. So do you think that's partially why we haven't gotten it yet? Because everyone's sitting back and waiting for that. And then the question is, when it happens, does it do a rug pull and go? Like everyone's waiting, buys there, and then it flushes us all out.
Yeah, you get 5 or you get 20.
Yeah,
right. I mean, you don't get 10.
That's what I'm showing you here. It's pattern recognition. Things I've learned is you never want to be getting too excessively long a market that doesn't correct. Go straight up, particularly if the fundamentals aren't really that great. Now, if it does it from a very low level, yes, but from all-time record highs. So this is what I show you: the S&P 500 E-mini. We have not had a correction on a weekly basis of more than 1.5%, which is the first week since the bottom. Pattern recognition rules is what happens when you have markets go straight up with corrections. They plunge. Markets go straight up. Here's a correction. Markets go straight up. Big plunge. It's just as in traders rules, you trade it with options. You can trade gammas, but you don't want to be stuck when it flushes. And I overlaid it with this copper. Basically, copper saying, this is on the same scale. And just S&P 500 divided by 1,000 and copper, it's been the same since 2015. Copper's looking at globally and saying, no, we're not going to do that. This is the Dr. Copper. So that's what I look at is this is where the trading opportunity is going to be. And that's why I like to ask myself and ask every trader, everybody who sits on a desk, runs money like you guys, that's leveraged and has a value at risk model, which I'm do. The next big thing to move is when beta has a little bit of a back and fill. Just a 10% correction is nothing. That's going to be the decision-making time to really put on big positions. And that's for me is why I'm showing you this. That's why this pattern recognition rule is, that's pretty scary. Now you got volatility on this 90-day, 180-day VIX volatility running at least the VIX is taking less than T-bill. It's at a 20-year low. So warning signs are there. And that's, I think, part of the reason that I'm so, I think gold is taking off. This is a record high in gold. And I put gold per ounces on the same scale as S&P 500, going back 25 more now, almost 27 years to show you that at some point, the risk is just a little reversion. Gold up, S&P 500 down.
Let me throw this question out to you guys. So speaking of, corrections in markets and inflation, obviously inflation's front and center. We've seen the CPI data, the PPI data be hot. Tomorrow we get the PCE data, which will be interesting because the stock market's actually closed when this data will be released. But I was hearing someone talk about the last, 20, 30 years where inflation was basically zero or, under 2%. And the concept was that China, because China was coming online and becoming a mass exporter, was driving prices down. But now we're seeing China inflation start to creep up. And potentially they're changing from that to more of a consuming nation. Does that then create a scenario where inflation could actually remain higher? And we've all thought, oh, this is just a great environment. Inflation's always going to be low. But is it possible now it's higher? It stays higher for longer?
I got to grab onto that one, Gareth, and you teed me off. I just love how we are extemporaneous, and yet that's a perfect tee off because here's what inflation is doing in China. This is the Chinese government 10-year note yield. It's the lowest in our database since 2006. China is imploding. Everything you hear that's the otherwise, look at the bond. Bond yields are kind of hard to mess with. And if the government's buying them, because there's a big problem. So that's bond yields collapsing. Overlay with the Bloomberg Commodity Index, this is deflating. That's what deflation is. When you get too high, you go down. I look at the Bloomberg Commodity Index, it's got another potential 30% to go lower if China's a guide. And it's not just China. Look at the Hang Seng Index. So this is a perfect lead into what's happening. So here's one way to look at it. Now that's the macro. Here's the micro. What is Huawei doing to Apple? Just what you'd expect. Just what Jeff Booth predicted in his book, The Price of Tomorrow. What is BYD doing to Tesla? Just what you'd expect. Crushing that into deflation now, and I'll end with this, and we can tilt on. This is a chart I started messing with a little while ago. Now, Scott, we've talked about this. Gareth, we have too. Now, we have unemployment in the U.S. just starting to tick up from a multi-decade low. It never ticks up without going up, basically doubling. It never has. Maybe it's the first time, but at the same time, I'm showing you this is CPI. CPI spiked. Now it's actually below unemployment. You know what's the last time we did that? It spiked and then dropped below unemployment rate was 1982. And what happened? This trajectory is clearly recessionary. That's why the Fed has to think about easing. But the key thing I'll point out is what I show here is they're probably not going to ease until they get a trigger. And what's the best trigger there is? It's a little back until the S&P 500. Yes, McGlone's been wrong. But now that we're this high, that's what I'm worried about, is what's going to take for that little trigger to start easing. The rest of the world started. The quote I heard is almost 1/3 of central banks have started easing, including Swiss National Bank, Brazil, and Mexico.
Which answers the DXY question, by the way. People, I talked about this on my show, but people can't understand in this new paradigm that we have here how stocks, that's SPX, can be going up, gold can be going up, Bitcoin can be going up, and the dollar can be going up. Well, the dollar's going up because, the Swiss bank and the Paraguay and Mexico and Brazil are easing, right? So it's just relative to other currencies. It's not in a vacuum. So we have one of those strange moments right now where DXY can be showing strength and everything else is going up with it. At least everything else we're looking at.
The dollar's going down versus Bitcoin, gold, and the S&P 500, but versus every other fiat currency on the planet, it's going up.
Exactly. So do you think that the stock market, guys, is going up not necessarily because the U.S. is just amazing, but because everyone else is struggling, so money is just continuing to flow into the country?
Yes.
Yeah, I think that's part of it. And I look at it, it's a classic blow off top, where you probably, prudent investors are underweighting and looking at other alternatives. Why are you seeing all these ETFs flows into Bitcoin? Because they know if it does continue to happen, Bitcoin's going to be the fastest horse in the race and continue to outperform. So I think that's a key thing. But that U.S. exceptionalism is pretty extreme now. You look at the S&P 500 divided by the rest of the world's equities. We use the MSCI ex-US. You go back to 1980 on that one. It's the highest ever. And you look at bond yields in the U.S. I just look at that U.S. 10-year note at 4.3. Every single other major bond on the planet is in a 3 or 2 handle, most notably China and Europe and Canada and Greece. And so how long is that going to last? It's just that thing I think is going to happen is we just get that little normalization, stock market corrects, and I think we drop a handle in the 10-year note from 4.3 to 3.3, and it's still well above China and most of the rest of Europe.
Scott, I brought this up, Gareth. Yeah, I was just bringing this up. Sorry, the ETFs, because Mike kind of talked about, Bitcoin winning, and we're obviously seeing so much volume. I don't know if you guys saw Larry Fink from BlackRock's interview yesterday. I mean, he said even he's surprised at the success of these. Went out on a limb, said these are by far the most successful ETF launches of all time. BlackRock now has 250,000 Bitcoin in their ETF. They're at 17.7 billion market cap. Grayscale only at 24. That's going to flip, right? So we're going to see that Grayscale become not the dominant player, and now Fidelity over 10 billion. So I just want to make note, we can talk about charts and whatever, but while we have this sort of massive, sizable inflow and fundamental underpinning of a nascent market like Bitcoin, it should continue to generally hold up.
So when do we get a rate cut, Scott? Like, are we still getting 3 this year?
Let's talk, because this is my favorite thing that happened in the last 2 days that nobody's talking about. I obviously saw Waller's comments yesterday where he once again said, whoa. We have no reason to cut. We need a few more months of data. We'll take a look. We'll see down the road, right? That didn't exactly echo what Powell said, but we have seen the Fed consistently said maybe cut, but no reason to do it yet. Predictive markets, as we've talked about 100 times, have been wrong. Do you want to see the title of his speech? This is what he chose to title his speech yesterday. There's still no rush. Why do people think that the Fed is going to cut when the Fed governor is making speeches that he titles, there's still no rush?
So if in that form, number one, so Powell was just, is this a game they're playing where he comes out dovish, the other guy comes out hawkish, or like what's the deal here? I don't understand. And why are the markets just, if we're not going to get cuts, or let's just say we get 1 cut versus 3, why are the markets still pushing up and away?
If that's for me, go ahead, Mike. I was going to say that's my question.
The answer is yeah. I wish I knew that question.
Up makes up,
so
right?
Here's the way I look at it is not so much, and I'll tilt over to what this chart means in a little bit, is gold ETF outflows versus Bitcoin ETF inflows. The answer to that question, I think that's the problem. We're at that stage now. I remember it clearly in 2007, definitely in 1999, where your performance is you have to keep up with beta, and if you don't, you're fired. But we're at the point now that everybody knows that, okay, great, once the Fed starts easing, the example of beta going up is pretty bad, particularly when it's the most expensive ever versus GDP, versus sales, versus commodities, versus many other equities. So it's the key thing that I think that's part of what's, I think, bidding gold. But I want to, so I don't know, but I just look at from a money management standpoint that it's unsustainable. And that's where I think you have to expect beta to have a bit of a correction. Now, that's one thing benefit. We've had a pretty good correction in Bitcoin this year, and we really beat it up. I mean, obviously threw me off the ship for a while and then back on, but that's trading. You got to get thrown back off and get back on. And if you never do, because you've never traded, it's just the way it is. You're never always right. Gold's had a pretty good correction. It dipped below 2,000, now back up. S&P's hasn't. So that to me is every major trader on the planet, I think, knows, okay, let's just wait to see how that works out. It always will. The question is from where. And I just want to tilt over to one thing I wanted I was just showing you, because we mentioned ETFs, is there's significant inflows in Bitcoin ETFs. Obviously, you mentioned that. And there's significant outflows in gold ETFs. And this is something that's never happened. We have gold ETFs plunging. Last time we had a plunge in gold ETFs was right when gold peaked in 2012. The thing is, now gold ETF holdings, this is total ounces, it's 82 million ounces, is the same as it was at that peak in 2012. So that old high is now support. But key thing I want to point out, I think is going to really matter this year, and based on your question, Gareth, is this chart here. This is just the S&P 500 divided by gold. It's the total return. So it really shows you what it is. And it's bumping up against the high from, it was a 20-year high, was right at the peak in 2021 before the Fed started hiking. We're bumping up against that resistance in the S&P 500 to gold ratio, and gold ETFs are potentially bottoming. To me, that's going to be the big trade of the year, is when we see a bit of a divergence, and particularly if we see gold starting to outperform the S&P 500. What's going to take? Just a little correction, and then the dominoes start tumbling. And that's how you trade. To me, that's what's going to be the key thing I'm watching. Is gold's S&P 500 is holding that resistance versus gold, and ETFs and Bitcoin, and gold are still starting to hit some key support levels.
So Mike, you mentioned 1999 and 2007. Is that what you think? You think that this is the year that, or the last year, let's say, that the gains have been so robust and so kind of out of whack that we're setting up for one of these bigger 50% move down in the stock market?
Oh, well, unfortunately, history shows that's the guide. Every time we've had the last two big significant corrections in the S&P 500, I'll overlay it with gold, is it's corrected 50%. Now I show you the peak in 2000 to 2002, so it's 50%, no big deal. Peak in 2007 to 2009, 50%, no big deal. Why shouldn't we do that again? So that's why I just put a simple little thing. It's 3,000. In the macro big picture, if you're not in the trade and you're looking back from 30,000 feet, you look at it and say, okay, it's easy. Gold should go up to 3,000. S&P 500 go down to 3,000. In a normal recession, here's the key thing about, I've said this a year ago, I was wrong, but the world all agreed that we're going to have a recession. Now the world's completely tilted the other way. Now we know that part of human nature is so fickle, it will never change. That's my key point, is all we need is that little nudge back to tilt back. Like Waller said this morning, there's no reason to ease yet. That little tilt back, we see a little reversion in the stock market, that's where it all starts, the dominoes start to tumble. You don't really get that recession unless the stock market starts figuring it out first.
So this is totally speculative for you guys, and this will be for both of you guys, but do you guys think that the Fed not raising rates is going to be the key for the sell-off, or do you think like the labor market cracking and actually the Fed cutting rates? Like, I mean, let's say the Fed starts to panic and they're like, holy crap, the labor market's falling apart, the economy's falling apart. Is that the catalyst? Like, or do we just stay strong with the employment data going forward? Because I mean, honestly, jobless claims today, 210,000, there doesn't seem to be any issues there.
Well, we know that data is somewhat fake, right? If you dig into it, it's migrants and second jobs.
So let's predict the future. There's no risk in that. I think what's going to happen has already started to happen in Switzerland, Mexico, Brazil. A lot of countries starting to cut rates, and this is what I think is going to be happening for the next elongated period, 5, maybe 10 years. That maybe at least 2 years. Central banks will cut rates reluctantly. In the past, they've been able to cut rates, go down on the elevator, and when they went up on the escalator. Here it's the reverse. As we go to this new stage of fighting what is still stubborn inflation and very elevated equities, to me, that's going to be a fight that's going to last forever, and we're way overdue for just a typical underperformance period in equities, which means the S&P 500, which means the U.S., and maybe we'll get that inflection point where Bitcoin will be the one to be the star. But right now I still see U.S. Treasury long bonds and gold and Bitcoin in that's, is potentially the best performance. But that to me is what I think is going to happen. It's a normal, it was put it this way. When I look back from the futures and I try to predict history books, that would make sense after the biggest liquidity pump in history that's dumping. And now we have this transition period where we still have a lot of wealth in the system. We have the most significant fiscal spending ever in this country. It's keeping things elevated, but normally you have to have some reversion of that big liquidity pump. Almost always that's happened in history.
Okay. Yeah, interesting. So turning our attention back to some crypto, Scott, I know everyone's here. A lot of people are here for some crypto. We've seen that meme coins have gone nuts. That's usually not the signal of a new bull market in crypto, but from what you're saying is at least with Bitcoin, it's starting, looks like it's clear sailing ahead. Like, is there going to be a bull market in the altcoins? I mean, is there any difference? I mean, what's the difference here in the cycle, or does it play out just like all past cycles?
I don't think it necessarily plays out like all past cycles, because the ETF money itself is not going to flow into the rest of the market, right? So money that goes into someone's IRA and an ETF that's held for 5% of their portfolio is not going to find its way into Dogecoin, which is what this chart is. But what we do have, and that Mike talks about often, I think, is the wealth effect. People who have been in the crypto market before these new entrants have been holding Bitcoin this entire time, and it's at all-time highs. They have a ton of money, and they're looking for beta and looking for opportunities to make money. And that's where the casino begins, right? With Bitcoin at an all-time high, there's so much more total market cap and money sloshing around in crypto, even without new money, right? Because everybody that's held through this entire bear market or was buying near the bottom is up. I've been making the point, it's kind of a new thing I've been thinking through. A lot of people said, well, when Bitcoin breaks 50,000, we're going to get mainstream interest. When Bitcoin breaks a new all-time high, it's going to be in the headlines. Everyone's going to talk about it. There's going to be new interest. And it's basically been crickets outside of the direct inflows into the ETFs. My new theory is, you're looking at a Dogecoin chart here, by the way, which is pumping, probably heading to 34 cents here. It looks like on a weekly chart. I think that people discount that almost everyone who came into crypto in the last cycle did not come in through Bitcoin. They came in through NFTs, Doge, SHIB, and the long tail of meme coins. And at the time, you were waiting 3 months to get on an exchange to be able to get Doge. You had to wait to get KYC'd on Robinhood or Binance or wherever it was. This time we have a complete shitcoin meme casino that's happening decentralized. Nobody has to sign up. Nobody has to do anything. You can spin these things up in 5 minutes. So it's a different meme coin cycle than we saw before. But if you want to know, in my opinion, when we see mass mainstream attention on crypto, it's when Doge reaches its all-time high, because this is the coin in the last cycle that got everybody going nuts and got them all buying at all-time highs. And this is the coin that everyone that that's not in crypto bought and is underwater on.
It's a good point. I still remember I was living in Oregon at the time, and the UPS driver, when this was at its highs, came and told me he got in. So I still remember vividly, and it was within a month or even maybe a couple weeks of the high. So that high
volume, you look at that. I mean, the all-time high volume on Doge is all the way on that one climb into the top over a couple of weeks. We haven't even come close to that kind of volume on Doge, even with it going up. So I think it's a little different this time, because the meme coins are really happening over in the casino that mainstream has no access to. Your average person isn't buying Joe Biden on some perp decks, on Solana. So as much as I think it's a sign of froth, I still think the wealth effect is very, very strong. And I think that's kind of what sent us on that last 17% correction.
Interesting. So now looking at crypto versus gold, Mike, which one's going to outperform here over the sorry, man. I know you're a big fan of both. So which one?
Exactly.
What do you do?
And so I think it's 6 years now I've been saying you cannot hold gold without Bitcoin in space unless you want to take inordinate risk of the world not going digital and Bitcoin not demonetizing gold. It is a process ongoing right now. The question is, does it end? And or it accelerates. I'm simple with trends. I see trends like this, and I think you're supposed to go with. You just kind of get knocked up in between and try to avoid that. But the key thing I like to point out is I am very worried that the total return on the S&P 500 for this year so far is 10.7%, and for gold it's 7.6%. It's right there. Gold is actually beating the S&P 500 since end of 2021. We're going on the third year now with a much lower volatility. That sucks in an environment, and you don't want the rock to beat stocks. in an environment where AI is all the rage. That's just a bad sign that it's for, I think, the macro and for equities. It's a good sign for gold. So I'm sticking with that view that I'll stick with. I think gold's more likely to head towards 3,000. Um, I'm afraid it might take a correction, but that's an enduring bull market. I'll end with this. It's the only major commodity that's going up, and for good reason. And at some point, when we flip these ETFs right there, then that's a recipe for gold to just take off. Now, I don't know. My main thing about gold is now it's about between 2,000 and 3,000. It might go back and retest 2,000. It's made people like me look like idiots for about 3 years now. I've been expecting this for a while, but it's just a matter of time it goes to 3,000, in my view.
Can you bring up my gold chart really quick, Gareth? Yep. I just want to show you, I think a lot of people were expecting 2,000, but if you saw that sort of all-time high break that was a fake out back in December, that became to me the new sort of line to break. And you can see that this dip that looked like that might be the moment it was going to go down, it tested it perfectly as support. Now today, actually, I think made a new all-time high. So gold, I think Mike's absolutely right. Gold looks like it's on the rocket to 3,000. And but that's not a good sign for the economy. It doesn't go to 3,000 without an S&P correction, in my opinion.
It's not. And that's why you have to tilt back. You cannot say gold without China in the same sentence anymore. And it's that unlimited friendship in Q1 2022 that established the axis of antagonists. I mean, it's just completely established. China, Russia, North Korea, and Iran. And that, who's the biggest buyer of gold on the planet? China, second largest economy. What else can they do with their money? The Chinese citizens have nothing left. And that's why I have some other things I want to show you just really quick. I'm showing this. I'm showing you this. Here's China collapsing. That's bond yields. That's deflationary. Lowest ever versus U.S. But one thing I want to show you where that should show up is, as a commodity guy, if you expect China to do better, copper should be breaking above 4 and stay there. I look at this recent pop above 4. That's a trade. As a trader, as an ex-trader, all right, most traders I think I'm putting on testing shorts. Put your stop above here. Look for it to go to 3. Same in crude oil. Recent pop, we're getting towards 83, the upper end of range. This is a decent contract near the upper end of last year's range. Sure, if it's going to break out higher, if the economy is going to do great. And right now, I see crude oil's got a pretty decent geopolitical bid in it. But I'll end with one chart. What's happening, and what happens in commodities, it doesn't happen in Bitcoin. Bitcoin does not have that high price cure. This is a supply of U.S. North America, Canada, and North American liquid fuel, crude oil and liquid fuel. Can you see the trend there from the lower left to the upper right? A lot of people thought this peaked here. I'm like, why? I'm just looking as a trend follower. This is very bearish for things like crude oil. And here's demand. Demand's peaked in 2005. Now that's the US, but that's the key thing that doesn't happen in Bitcoin. You don't have this, prices go up, supply kicks in. You basically, to fix this, you need prices to go down. It's the way it works.
Amazing. So just looking back at Bitcoin, Scott, and I'm curious myself, needless to say, most people, I would say it seems like 95% of people out there are bullish on it, especially after this options X. If you had to make a bear case, like what are let's say the top 3 risks for Bitcoin, right? I mean, as a trader, it's good to see both sides. What would you say were the top 3 risks?
Well, I think a massive outflow. It's funny because, we say the best marketing for Bitcoin, higher prices begets higher prices. Well, lower prices could beget lower prices if we saw major outflows on a significant correction. But we didn't really see that on the 17% correction, right? And even with these major outflows from GBTC, which are likely the unwinds we'll find out about from other bankruptcies like FTX, Gemini, and such, we saw very small dips. So it's very hard right now to imagine a specific underpin scenario where it would go down. I tilt to what Mike always says, which is like a major stock correction, some falling off the cliff of other markets. I think every correlation goes to 1 and things all go down at once. But historically, when that happens, Bitcoin gets the biggest bounce, right? I mean, even COVID, stock market doubled from the COVID lows. Bitcoin went up 17 times, right? So if you get that correction, where do you want to be?
Yeah, so I'm glad that I think that's the right answer. And the way I look at hot money, having been there, you guys I consider hot money, but I mean the highly leveraged, very big hedge funds, is they're all looking for that opportunity. Keep your powder dry, and then when you get that initial correction in beta, you pick out what you're going to shoot at. And that's why I want to see what's going to happen with Bitcoin. I just want to see, okay, if the S&P, when it corrects 10%, didn't say if, it's just a question when. Is it going to do it this quarter? It probably should. Maybe not. I mean, we'll sell in May, potentially. Does Bitcoin just correct 20%, which would be a major major divergent strength? Does it correct 30%? Well, who knows? Is that which one's a buying opportunity and which one's going to endure? If we have the S&P 500 correct 10%, and then you start seeing that global acceleration towards recession, which is happening already, and the Fed just starting to cut maybe 25, that is a global recessionary trajectory that I think it's already seen it in commodities. You see it in bond yields, yield curve, everything. That is going to be the test for Bitcoin. I think most people are sitting on and waiting, keeping their powder dry, playing with options, and just waiting to put on those big positions when we do get the opportunity.
Wonderful. All right, guys. Well, that's our time for today. Market Mavericks out for the Thursday session. You guys will be seeing us next Thursday, hopefully, and we'll do another round. Thank you, Scott. Thank you, Mike. Guys, follow these guys. You can see their socials at the bottom there. So follow them on Twitter there. And we thank you guys for watching. Thank you so much. We'll talk to you soon. Take care.
Take care.